On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice and it doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners financial advice provider disclosure statement, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Please engage with us. We love to get feedback, questions, and comments on this material, and if you enjoy it, please rate it, or even better, share it with a friend or colleague. The United States has found itself under increased scrutiny this year, with markets questioning whether it deserves to be on such a pedestal. America's success has been built on foundations of free enterprise and trade, the rule of law, as well as strong migration. It's been supported by the traditional safety of US Treasury bonds, independent monetary policy, and the reserve currency status of the US dollar. All of this has given America the privilege of borrowing money at interest rates lower than many would consider fair value. Current policy settings threaten this exceptionalism, and investors are becoming much less enthusiastic about funding the growing twin deficits of the world's biggest economy. We've seen a big shift in the perception of US assets, which has been reflected in falling growth expectations, a more volatile US share market, and higher US interest rates. However, currency markets are where all of these things intersect, and the most telling signs might have come from the US dollar. It slumped more than 10% in the wake of the tariff proposals in early April, and while the S&P 500 index has bounced back since then, the Greenback has stayed down. The US dollar does tend to move in long cycles, and the recent moves beg the question of whether we've reached another turning point in its fortunes. After falling through the 1970s, it started rebounding in 1980 when Fed Chair Paul Volcker raised interest rates sharply to combat inflation. It hit a record high in 1985 until the Plaza Accords saw several major economies agree to foreign exchange interventions to lower its value. That led to a US dollar bear market for about 10 years until the Fed began raising interest rates in the mid-1990s, which saw it rebound again. That bull run lasted until the dot-com bubble burst in the early 2000s, and the US dollar then languished until about 2011 when the European debt crisis seemed to spark a revival. It's difficult to say whether another turning point has been reached, but few would deny the events of 2025 have been significant. Not only have we seen proposals for the biggest change to US trade policy in 100 years, but markets are scrutinising US borrowing levels much more closely. At the same time, Europe has announced what is arguably the largest shift in European defence and fiscal policy since World War II. From here in New Zealand, the diverging fortunes are quite obvious to see. The S&P 500 index in the US has recovered most of its losses and is now close to flat this year. However, the US dollar has fallen more than 5% against the New Zealand dollar, so local investors are still down when it comes to their US shares. In contrast, European shares are up more than 10% this year, while the euro has appreciated against the Kiwi, boosting these gains even further. The US dollar has been the world's reserve currency for 80 years, having started to displace the British pound in the 1920s and then securing that undisputed mantle after World War II. Even so, its dominance has declined in recent decades. Its share of global currency reserves fell to 58% at the end of last year, the lowest in almost 3 decades, and down from above 70% in 2001. That reserve currency status is unlikely to be threatened in the foreseeable future, but the US dollar might have to increasingly share the limelight with others. The US economy is still in good shape, but policy changes could create headwinds at a time when the Fed has limited room to provide support because of those inflation pressures that are being created by the tariffs. At the same time, the greenback is under increasing pressure, and US stocks still remain more expensive than their international counterparts on many measures. A complete exodus is highly unlikely, but a partial unwind of US asset ownership is already underway as investors look to diversify into other markets, especially after the great run from the US in recent years. These asset allocation shifts can take some time to unfold, and that does suggest that non US assets might continue to outperform for a little while longer yet. Make no mistake, the US is the world's biggest economy, the world's biggest share market, and it is home to many of the world's greatest companies. However, against an increasingly multipolar backdrop, diversification isn't just prudent, it might be essential. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.